Britannia Industries just dropped its Q4 numbers, and the headline looks absolutely spectacular. Profit after tax shot up by over 21% year on year. But if you look closely at the stock price, the market didn't throw a party. In fact, we saw some immediate profit taking. Why is there a disconnect between a massive profit jump and the market's muted reaction? In this video, we are breaking down Britannia's latest Q4 performance, uncovering the structural issues that slowed them down in March, and running an exclusive macroeconomic stress test. What happens to Britannia if the RBI aggressively hikes rates by 4% over the next 2 years? Let's find out. Section 1. Breaking down the Q4 numbers. Let's look at the hard data. Revenue for the quarter came in at 4,718 crores rupees, up about 6.5%. But notice the divergence here. Revenue grew 6.5%, but net profit jumped 21.5%. How did they pull that off? It wasn't because of sudden operational explosive growth. This massive profit spike was primarily driven by internal cost efficiencies, structural cost leverage, and a lower effective tax rate, including deferred tax adjustments. In fact, if you look at operational margins, the EBITDA margin actually compressed slightly by 9 basis points year on year, standing at 18.07%. Sequentially, compared to Q3, margins dropped by a sharp 165 basis points. The management pointed out that January and February started strong with nearly 9% growth. But March threw a curveball. Ongoing conflicts in West Asia led to severe late-quarter international supply chain disruptions, cooling down what could have been a blockbuster quarter. The bright spot, premiumization and quick commerce. E-commerce now accounts for 6% of Britannia's domestic business, with brands like croissants, wafers, and legacy favorites like Little Hearts driving great momentum. Plus, the board rewarded investors with a fat final dividend of 90 rupees and 50 paise per share. Section 2. The 5-year financial trajectory. To understand where Britannia is going, we have to look at where it's been. Zooming out to a 5-year view from FY22 to FY26, we see a clear structural shift. Back in FY23, Britannia saw a massive 15% revenue spike. That wasn't volume growth. That was pure pricing power. They raised prices and cut packet weights to fight intense inflation in wheat and palm oil. From fiscal year 24 through fiscal year 26, revenue growth normalized to stable single digits, but the quality of growth improved. It transitioned into volume-led growth, especially as rural markets recovered. More importantly, their operating cash flow is incredibly resilient, consistently stabilizing well above the 2,300 crore rupees mark annually, thanks to an ultra-efficient working capital cycle. Section 3. The macro stress test. What if RBI hikes rates by 4%? Now let's play out a critical macro scenario. What if inflation spikes globally and the RBI is forced to hike interest rates by 50 basis points every single quarter for the next 2 years? That's a massive cumulative hike of 4%. How does a consumer giant like Britannia hold up? First, the bad news. The premiumization stall. A 4% interest rate hike sucks disposable income out of middle-class pockets due to higher EMIs. Consumers will likely downtrade from premium chocolate chunk cookies to standard mass-market biscuits. Volume growth would likely decelerate to a stagnant 2% to 4%. Second, the good news, the balance sheet shield. Britannia has spent the last few years aggressively deleveraging. Because their debt is incredibly low, higher borrowing costs won't hurt their P&L directly. In fact, because they sit on huge cash surpluses, their treasury income would actually shoot up as macro yields hit double digits. Under this severe stress test, we project Britannia's PAT growth to flatline completely through FY27 and FY28 at less than 1% growth, before recovering to roughly 8.7% in FY29. Once commodity deflation kicks in to rescue operational margins. Management's playbook here would be simple. Aggressively push 5 and 10 rupee packs, cut down capital expenditure, and preserve cash. The investor's verdict? The bottom line? Britannia remains an absolute fortress of an FMCG stock, backed by phenomenal cash flows and a rock-solid balance sheet that can withstand heavy macroeconomic storms. However, near-term top-line growth and international supply chains need careful monitoring before making your next move. What are your thoughts on Britannia's Q4 numbers? Are you buying, holding, or waiting for a deeper correction? Let me know in the comments below. Don't forget to hit that like button, subscribe for more data-driven market analysis, and click the bell icon to never miss an update. See you in the next video.